You know what? I've noticed something pretty unsettling lately. The recession actually started 18 months ago. Not the one they'll announce on television. Not the one where some economist points to 2 consecutive quarters of negative GDP and says, "Officially, we are now in a recession." I mean the one already running underneath us right now. Let me show you the numbers. Consumer credit card debt hit $1.2 trillion in 2025. Small business bankruptcies are up 31% year over year. And the 10-year Treasury yield in early 2026 is sitting higher than it was at the peak of the worst inflation crisis America has seen in 4 decades. That's not a warning sign. That's the system already on fire. And somebody decided not to pull the alarm. Now, you might be wondering, what does this have to do with me? Here's what makes this different from every other "recession is coming" video you've seen. We're not talking about a cyclical downturn. We're talking about the first measurable stages of a monetary system transition, a change in the rules of money itself. Honestly, my 401k was designed for the old rules, and those rules may be in the process of expiring permanently. So in the next 20 minutes, I want to walk you through the mechanics of how this actually works, the historical patterns, the 5 specific forces converging simultaneously that haven't all fired at once in 80 years, and the 3 things I'm actually doing with my own money. Multiple hundreds of thousands of dollars spread across index funds, real estate, and yes, some gold. Not because I want you to copy me, but because I want you to understand the reasoning clearly enough to apply it to your own situation. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Now, let me share a metaphor I've been using a lot lately. One we're going to keep returning to throughout this entire video because it does more explanatory work than any chart I could show you. You know what? After World War II, the world signed a lease with the United States. The terms were actually straightforward. The US dollar would serve as the global reserve currency, meaning every country would hold dollars in reserve and settle international trade, especially oil, in dollars. In exchange, the United States promised a stable currency, manageable inflation, and the military power to keep global trade routes open and safe. That lease has been running for 80 years, and for most of that time, it genuinely worked. Countries got access to a stable, universally accepted medium of exchange. America got an extraordinary privilege, the ability to print the world's reserve currency, which meant it could run deficits that would destroy any other nation on Earth and still find buyers for its debt. Both sides of the lease benefited. But you know what? Here's the problem with long leases. The landlord starts taking liberties, and the tenants start looking at what else is out there. The first liberty the U.S. took was in 1971. Nixon closed the gold window. Before that, if you held dollars and you were a foreign government, you could theoretically exchange those dollars for gold at a fixed rate. After 1971, you couldn't. The dollar became backed by nothing except trust and the full faith and credit of the U.S. government. Trust is a psychological asset, and psychological assets don't decay linearly. They hold, they hold, they hold, and then they don't. We're in the "and then they don't" phase. Speaking of which, I need to show you something about the structure of U.S. debt that makes everything else click into place. The U.S. national debt is now $36 trillion. That is 120% of GDP. If I made $60,000 a year but owed $72,000 on credit cards, my debt-to-income ratio would be identical to the United States government right now. Now, you might be thinking, Okay, but we've had high debt before. After World War II, debt to GDP hit 106%, and we recovered. True, but here's the reversal I need you to understand. You think the debt level is the problem? The debt level is not the problem. The structure of the debt is the problem. After World War II, the U.S. was demographically young. It had a massive domestic manufacturing base. It was a net creditor, meaning other countries owed us money, not the other way around. It had decades of productivity growth ahead of it to grow out of the debt. Now, aging population, offshore manufacturing, net debtor. And here's the number nobody wants to say out loud. In 2025, interest payments on the national debt exceeded $1 trillion for the first time in American history, more than the entire U.S. defense budget. The United States is now spending more servicing its debt than protecting its borders. That is not a debt problem. That is a Ponzi structure. And Ponzi structures have exactly two endings. You either find enough new buyers to keep it going, or the whole thing collapses when the buyers disappear. For 15 years, the Federal Reserve played buyer of last resort. Every time Treasury yields spiked, every time the market said, "We don't want to lend you money at these rates," the Fed stepped in, printed money, and bought bonds. It's called quantitative easing in polite company. In honest company, it's called monetizing the debt. And it works, right up until it doesn't, because it is also called inflation. And you know what? Even after 2 full years of aggressive rate hikes, inflation is still running above the Fed's 2% target. The 10-year Treasury is yielding above 4.5%. That means the market is demanding more compensation to hold U.S. government debt because the market is nervous. That nervousness is the lease getting wobbly. Speaking of which, let me tell you why every major signal Ray Dalio has been warning about for 5 years is now measurably flashing red. Dalio runs Bridgewater Associates, the largest hedge fund in the world with over $150 billion under management. He spent years studying what he calls the big debt cycle. He found a pattern so consistent, it's almost embarrassing. Every reserve currency goes through the same arc: rise, dominance, overextension, decline. He published a book called The Changing World Order in 2022, and I read it twice and then read it a third time with a highlighter. Right now, all 5 forces are flashing simultaneously. That hasn't happened in 80 years. Let me start with internal disorder. In 2024, the top 1% of Americans held 32% of all national wealth. The bottom 50% held 2%. That wealth gap is wider than it was in 1929, the year before the Great Depression. Speaking of which, what does that actually mean for our money? When wealth inequality becomes extreme, it creates political instability. And political instability makes institutional investors nervous about holding long-term U.S. government debt. If you're not sure a government will honor its obligations 20 years from now, you don't buy a 20-year bond at 4%. You buy gold. You buy hard assets. You move money into things that can't be inflated away or defaulted on. And that's exactly what we're seeing. Central banks around the world purchased 1,037 tons of gold in 2024, the second highest year on record. China, Russia, India, Turkey, they are not buying gold because they think it's pretty. They are quietly, systematically reducing their exposure to dollar-denominated assets. This is the institutional equivalent of the smart tenant quietly touring apartments while still paying rent so as not to spook the landlord. Speaking of which, let me bring in external disorder. In 2022, the U.S. locked Russia out of the SWIFT system, the global network that processes international bank transfers. It was called a financial nuclear option. It froze hundreds of billions of Russian foreign reserves denominated in dollars. But you know what about nuclear options? You only get to use them once. After that, every country in the world that has ever been in a geopolitical dispute with the United States starts building a bunker. Here's a story that captures the dynamic. A small island nation once conducted all of its trade through a single shipping company. The company had the only dock on the island, so the island paid whatever rates the company charged, followed whatever rules the company set, and didn't complain because what choice did they have? Then, one year, the company seized a shipment over a political disagreement. The following year, a competing company built a second dock on the other side of the island. Suddenly, the island had a choice, and the moment it had a choice, the original company's pricing power vanished overnight. The SWIFT sanctions were the seized shipment, and right now, the second dock is being built in real time. Russia and China began settling energy trades in yuan and rubles. China and Brazil signed a deal to trade in their own currencies without dollar conversion. The Gulf states, the same countries that created the petrodollar arrangement back in the 1970s, are now openly discussing pricing oil in a basket of currencies. When you weaponize the dollar, you teach the world to build a financial system that doesn't need the dollar. That's not a conspiracy. That's incentives. Speaking of which, I want to introduce you to Marcus. He's not a specific person, but I've seen his pattern in enough conversations with real people that he might as well be. Marcus is 44 years old. He has been maxing out his 401k since his late 20s. He has a diversified portfolio, roughly 60% equities, 40% bonds. He checks his balance every quarter, and the number goes up, and he feels good. Marcus is the tenant who just renewed his lease for another 5 years without reading the new clauses. Speaking of which, let me give you a specific case study. Meet David. He's 42. He has $350,000 in his 401k, almost entirely in a target date fund set for 2047. He earns $110,000 per year. He's run the numbers on every major retirement calculator he could find. They all tell him roughly the same thing. He'll retire at 65 with approximately $1.8 million. On paper, David is doing great. Here's what those calculators assume. 7% average annual real returns, 2.5% average annual inflation, and this assumption nobody ever states explicitly, that the dollar in David's account in 2026 buys roughly the same basket of goods as the dollar he retires with in 2047. Blow up any one of those three assumptions, and David's entire retirement math falls apart. Take inflation. If inflation averages 5% annually instead of 2.5% over the next 23 years, David's $1.8 million at retirement only purchases what $800,000 purchases today. He just lost $1 million of purchasing power, and his brokerage statement will still read $1.8 million. The number looks the same. The purchasing power is gone. Speaking of which, let me take a quick detour because this is a lot of structural doom, and I think we both need a breath. Imagine you're the Federal Reserve Chair in 2028. You're sitting in a mahogany-paneled room with 3 advisors. First advisor says, if we raise rates, we crash the stock market, and Congress summons you to testify for 6 hours. Second advisor says, if we cut rates, inflation goes back to 8%, and the same Congress summons you to testify for 8 hours. Third advisor says, if we do nothing, the bond market stages a revolt. And, wait for it, everyone in that same Congress blames you, personally. and you're just sitting there in a $6,000 suit thinking about the McKinsey partnership offer you turned down back in 2009, wondering if it's too late to call them. That's not satire. That is genuinely the position the Fed is in. Speaking of which, there's a fourth force we haven't discussed yet: technology, specifically AI. The IMF published a working paper in 2024 projecting that AI could affect 40% of jobs globally. If AI drives the cost of goods down, maybe that counteracts inflation. Maybe it buys the US time to stabilize its fiscal situation. Maybe. But you know what? If AI displaces 40% of jobs and those workers stop earning income, they stop paying taxes, they stop consuming, and the government has to step in with more spending, which means more deficit, more treasury issuance, more downward pressure on dollar credibility. Speaking of which, here's where it gets genuinely weird. There is a real possibility, not a certainty, not even a probability, but a real and non-trivial possibility that the US response to all of this is to back the dollar with something tangible again. On the gold side, the US reportedly holds 8,000 tons of gold. At current prices near $3,000 per ounce, that's worth approximately $760 billion, which sounds substantial until you remember the national debt is $36 trillion. To collateralize even 10% of outstanding treasury debt with gold, you'd need to revalue gold above $43,000 per ounce. On the Bitcoin side, the US government currently holds over 200,000 Bitcoin. If the US were to formally announce treasury instruments backed by Bitcoin, it would legitimize crypto as a reserve asset overnight. Speaking of which, Venezuela reportedly holds somewhere around 600,000 Bitcoin. The United States has recently been increasingly attentive to Venezuela diplomatically. That's probably a coincidence. But you know what? When you understand that reserve currency competition is fundamentally a war fought with monetary instruments, you start seeing connections between events that look completely unrelated in daily news coverage. Speaking of which, let me come back to Marcus one final time. Marcus might be fine. He might retire in 2047 and discover that the dollar remained dominant and his target date fund delivered exactly what the brochure promised. That outcome is genuinely possible. But Marcus is not making a conscious choice. He's making an unconscious bet with his entire retirement. Understanding the bet you're making is not pessimism. It's basic financial literacy. And right now, most people don't have it because the financial industry profits from them not having it. Speaking of which, here's the most underappreciated scenario. The most likely outcome is not the collapse of the dollar. It is a multipolar monetary system. In that world, the dollar doesn't collapse. It weakens gradually. 5% one year, 3% the next, over a decade. You don't feel it until you try to price your retirement in terms of what it actually buys. Speaking of which, I've spent over 10 years running my own business, working alongside accountants and fiscal lawyers who showed me how money actually moves behind the formal numbers. The consistent lesson? The game is not about being the smartest person in the room. It's about understanding which game you're playing, and specifically about being one of the first people to notice when the rules change. Most people are still playing the 1985 version of this game, but the conditions that made it work are under genuine structural pressure for the first time in a generation. Now, to be absolutely clear, none of this means you should panic and liquidate everything. Panic is the worst possible response to a slow-moving structural shift. The right response is calibrated adjustment over time, informed by an understanding of the actual forces at work. So let me give you 3 specific, non-generic responses calibrated to this exact moment. First, stress test your retirement projections against 5% average annual inflation instead of 2.5%. Change that number to 5 and see what it does to your projected purchasing power. If the result is catastrophic, you need to know that now, not at 63. Second, look at the duration of your bond holdings. If your average bond maturity is above 10 years, you have significant duration risk. Moving towards shorter duration bonds is not a bearish bet. It's removing an unnecessary risk. Third, introduce some exposure to assets that are not positively correlated with the dollar. International equities, a modest allocation to gold, a small Bitcoin position, income-producing real assets. The people who survived every monetary transition in recorded history were not the ones who held the most gold or the most cash. They were the ones who owned things that generated genuine value independent of any particular monetary system. Speaking of which, that principle is older than the Federal Reserve. It's older than the dollar. It will outlast whatever comes next. You know what? The lease is up for renegotiation. Not necessarily for termination, for renegotiation. The terms that the world accepted for 80 years are now being questioned by players with enough economic mass to credibly threaten to walk away. Being aware that the negotiation is actively happening right now is the foundational requirement for making intelligent financial decisions over the next 20 years. Speaking of which, here's the thing about slow-moving disasters. And I know this sounds cynical, but I think it's just true. The people who get hurt worst are not the uninformed optimists who never looked at the data. They're the people who were informed, saw the signals, made a mental note to deal with it later, and then didn't. That's not optimism. That's expensive denial. And at compounding rates. Expensive denial is the most reliable way to destroy wealth that I have ever observed. Lazy investing built more fortune than crypto memes. But lazy investing in 2026 means understanding the macro environment your portfolio is operating inside of. Not ignoring it in the name of passive strategy. The strategy is still the same. Invest consistently, minimize fees, let compounding work. What's changed is the backdrop, and understanding the backdrop is not optional anymore. The tenants are moving out, the landlord is changing the lease terms mid-contract, and the apartment building next door is starting to look